this discussion, I'm going to talk to you guys a little bit about alternative capital budgeting rules. In a prior presentation, I talked to you about the net present value rule for capital budgeting, which is, as we said at that time, sort of the gold standard right now for capital budgeting. And I thought it would be worthwhile for you to be aware that there are there are always these other rules that people put forth and say, well, I prefer this one or I prefer that one. And so I want to look at a couple of those kind of ends of the spectrum, if you will. On one end, I'm going to look at a method that has been used before net present value was around. And then at the other end of the spectrum, I'm going to look at a method that was developed after net present value and is just starting to be used and considered in some companies, sort of give you the spectrum, if you will, on that. So, first one of those methods is the what's called the payback period. And so my objective for you on this is that I want you to be able to describe, using an example, how the metric's calculated and used to determine whether or not to invest in a project. In other words, how would somebody use this rule? Then I'm going to talk to you a little bit and would like you to be able to explain why some firms might prefer this to the NPV rule, kind of what are the typical justifications given by firms that use this rule. And then lastly, I want you to demonstrate at least one situation where the rule might lead to an incorrect decision, meaning a decision that doesn't select the project with the best value. So let's talk about the rationale kind of underlying the payback period. Let's assume that the initial investment is an amount of money that the shareholders have given the company, and that the cash flows from the project will be paid back to the investors as dividends as they're earned, very much like we've done in other examples, and that the investors have in mind some defined period, say 3 years, 5 years, whatever they decide, that they require to have their initial investment returned to them, and that's sort of their focus is I would rather have the cash flow sooner rather than later, and I would like to have enough of them to at least pay me back what I have initially invested by some period of time. And then the idea would basically be that any additional cash flows that become dividends beyond that point, that everything's repaid, are just considered a windfall on the project. So under that kind of scenario, managers and investors have come up with a simple metric called the payback period, which calculates the amount of time in years required to pay back the initial investment. So for that, you would basically need your cash flows, just like we did before, and the initial investment, just like we did before. But we don't need a discount rate. We just solve for how long it takes before the cumulative value of all of these pays back this. And so in sort of a simple calculation, you can imagine, again, in our example, we had an initial investment of $1,000. Here are our cash flows. And all I'm calculating is what's left to pay. So after year one, we get $200 back. We have $800 left to pay. In year two, we get another $300 back. So we take that from the $800. Now we only have $500 left to pay. In year three, we got $400 back. Still doesn't fully pay us back. We got $100 left. All right. Year four, we get $500. Well, that's more than enough to pay it back. So we know that now, right away, the payback period is going to be somewhere between 3 and 4 years. And to figure out exactly how long, we just assume that the money, the $500, gets paid back kind of smoothly throughout the year. And so we only need 1/5 of this $500 to finish the payoff. 1/5 is 20%, so 20% of a year, we assume that in the first 1/5 of the year we'll get $100. That'll be enough to pay the rest of it off. And so we would calculate a payback period of 3.2 years, 3 1/5 years basically. So it's pretty simple. Obviously, we like that, we don't have to do any sort of um, present value or future value calculations or anything like that. And so it becomes the kind of thing that you could pretty much do on a back of a napkin or on a sheet of paper with pencil. And then once you get the payback period for your project, you compare it to some maximum acceptable payback period that you have agreed upon in advance. And so if your project gets paid back in less than the maximum acceptable period, then it's acceptable. If it gets paid back in equal to the maximum acceptable period, it's also acceptable, because again, that's the minimum acceptable period and you just came in under the wire, basically. But if the payback period is greater than that maximum acceptable payback period, then the investors would say the project takes too long to pay back, and so it's unacceptable. So that's as simple as the rule gets. Just, does it happen soon enough? If it doesn't happen soon enough, then we don't like the project. So why do we like it? And why do we still use it? Well, probably, arguably, aside from the fact that it's just so simple and kind of intuitive to talk about, we probably still like it because it was one of the first rules that companies have used for capital budgeting. Because of the simplicity of the calculation, you didn't need a calculator, you didn't need higher math skills, you didn't need any of those sorts of things. And so, it's been used for over a century, basically, to calculate values or to make decisions about projects. And it's just sort of ingrained. And so, you wind up with this thing. I'm sort of jumping around, but if you think about it, if you're an executive and you're, let's say you're in your 60s now, and that would basically mean that back when you started with the companies that you were with in your 20s, then that was before the advent of the personal computer. The little calculators were, I guess, somewhat available, but even those had limited abilities. And so, at the end of the day, unless you wanted to pull out your slide rule, your company probably used payback period for how to decide on projects. And so that's what you grew up doing, was making decisions based on payback period. And you now have 40 years of experience of being able to use that method and your business intuition to pick projects and see how they turn out. And so you have this sort of innate sense, if you will, of when a project looks good or not good relative to this payback. And it just has been the way that you've always sort of picked out your projects, and you're not going to give it up. And so at the end of the day, it's simple, it's easy to calculate, doesn't require any assumptions about discount rates, reinvestment of cash flows, any of that sort of stuff. You could do it without a calculator or computer, and basically, kind of the old guard, if you will, of executives. That's what they've been using for so long that they're not going to give it up. So the question then becomes, well, what are the issues with it? I mean, it seems that you can look around and see a lot of companies that started out making project decisions doing this, and they're still around today, and they seem to be doing very well. So it couldn't be that bad, right? And it's simple, and you don't have to figure out discount rates or any of that sort of stuff. So that all seems favorable for it. So what's the problem? Well, from an academic standpoint, remember that we view that your job is as a manager is to add value to the company, and it needs to be value above and beyond the cost of capital. And you need to have some sense, if you had to pick between projects, let's say you couldn't do them all, you want to make sure that you get the ones that add the most value. So in that context, let's consider, first of all, the payback period does not consider any of the cash flows for a project that happened after the point in which the initial investment's paid back. And so, you just calculate, we get, it takes this many years to pay it back, and we don't really care what happens after that. So if two projects took the exact same amount of time to pay back, we would say that they were pretty much equal, irrespective of what happens afterwards. It does not explicitly account for the cost of funding, and therefore doesn't consider the timing of cash flows. And keep in mind that, for example, with net present value, that cost of capital, that cost of funding, that's where we incorporate the cost of risk. And so by virtue of that, it really does not reflect what the riskiness of the cash flows, if they're different from one project or another, there's not a place in there to reflect that. And lastly, with the cost of capital, we tie the threshold back in terms of what the right capital number is. I shouldn't say the threshold, but what the right cost of capital is. We tie it back to whatever the market cost of capital is for projects with that kind of risk. Here, there's no sort of similar market-based way to set a benchmark for what the appropriate payback period is. It's hard to assess out in the market, first of all, how long it typically takes for projects to pay back, and secondly, there's no evidence that people are using it. There's not a lot of good information out there for you to say, it should be based on that. And quite frankly, it generally isn't. It's just based on whatever you guys have settled on as your rule. So it's a little bit more arbitrary in that sense. So let's kind of break those down with some examples. So we say it doesn't consider cash flows beyond the period in which the initial investment's paid back. So think about two projects. Let's say they both cost you $100,000 in initial investment, and your target is that you want them to pay back in 3 years or less. And Project A has cash flows so that it pays you back in 3 years exactly, but after that 3 years, you basically don't really have any cash flows. So the project effectively just barely pays you back. It does it in time, but it just barely pays you back, and you really don't make much other than just getting your money back. The second project doesn't quite pay you back in 3 years. It's in 3.1 years. But in the year after, so during year 4, but after it's paid you back, it's going to earn $10 million. So the payback period rule would basically say that Project A should get done and Project B should not. Or if you were ranking them, and let's say that you instead of having a payback period of 3 years, you had 4 years, you would rank Project A as better than Project B because it pays back faster. And so, those kinds of results are things that we all would look at and say, well, no, I don't think I like Project B better than Project A in this case. And so the rule leads to you maybe picking your projects, not picking the projects the way you would like to. Another issue, again, like I said, doesn't explicitly account for cost of funding and therefore timing or risk. So let's again consider two projects. Again, our threshold sort of maximum acceptable payback period is 3 years. Project A is a $100,000 investment. It's very risky, and you basically do not get any cash flows on it until the 12th month of year 3. So right at the very end of year 3, you get all $100,000 back, and that's how you get paid back in the 3 years. Now there's significant risk around that $100,000. That's just what you expect to get. You may get a lot less or a lot more, but based on the payback period method, you would say, okay, 3 years, it's acceptable. And Project B, now let's consider this one. It's also a $100,000 investment. You consider it not very risky at all. There's not much uncertainty about when you're going to get your money. And let's just say that the month after you invest, you're gonna get the first $99,000 back. That's part of the reason why it's not very risky. And then you're gonna get the rest of that $1,000 kind of a little bit at a time spread out over the next, 2 years and 11 months basically. And you're gonna hit that magic number of $100,000 right at the end of year 3 again. So under the payback period approach, you would consider those to both be equally desirable and acceptable based on the rule, because again, the only thing you're supposed to look at is how long it takes them to pay back. They both pay back at exactly the same time, and so you would consider them both to be equally desirable, and you would rank them as being basically the same quality of investment. So those are kind of examples where hopefully it highlights for you that the payback period has its flaws. Before we leave that, I do want to make an important point to you, sort of in deference to payback period users. The examples that we often use from an academic standpoint are structured around this idea that you got guys in a room making a decision on investment projects, and the only piece of information that is allowed in the room is what's the payback period, and they're not allowed to look at anything else. Number one, that's simply not true. You would never make a decision, nobody, either previously, prior to computers or now, would make a decision on a business investment based solely on the number without knowing anything else about the cash flows, what sorts of assumptions went into them, anything else. And so this is a little bit of a contrived issue. The bottom line is that a knowledgeable user, a company that has experience making investment decisions, would obviously point out the fact that if there's some huge windfall or loss just beyond the payback period cutoff, that's an important consideration in their decision. They wouldn't just ignore it just because there's some rule that says, oh, look at this. I think the way you would think about it is you look at that, but you also look at other things. And also, as it relates to this timing and cash flow and cost of capital thing, I know from experience that people that use the payback period don't necessarily use the strict definition of operating cash flows that we've used within PV. And in particular, they often include the cost of financing, both an interest charge and maybe even an explicit charge for equity, cost of equity. They often include that in sort of getting to the cash flows that they use for payback purposes. And so they would reflect something related to cost of capital. It's not quite theoretically as correct as the NPV does it, but certainly by doing this, they are, they would become closer to, respecting the fact that, cash flows that happen earlier are more valuable than cash flows that happen later. And they would also be reflecting the fact that, if my project's more risky, I could assume that my cost of capital would be higher and reflected in that. And so, again, while the sort of strict definition in the textbook of payback period seems to suggest that this stuff's not considered, I know for a fact in the real world that people that use it have done things with this approach to try and make it more reflect some of the things that they know should be considered. The second method that we're going to look at, or approach that we're going to look at, is the internal rate of return rule. And it's a little bit different beast than the payback period. Payback period is something that was used because of its simplicity. It was easy to calculate before there were computers, and so it's a very old method. Internal rate of return, on the other hand, would have been much harder to calculate even than net present value by hand, and we'll see why here in just a second. And so it's a newer method that really is brought on by the fact that you have computers and spreadsheets and all that nice stuff. Makes it easier to use for more types of projects. And so I think partly just because it's a new sort of whiz-bang way of looking at things that you couldn't look, in a way that you couldn't look at them before, it's starting to pick up notice, and there are starting to be people that want to use it. And so we want to talk about this one. So instead of the very old, we're now talking about the very new. And same things I would like you to be able to do with that. Want you to use an example of your own design to describe how it's calculated and what the rule is around how you determine whether or not to invest in a project. Talk about some of the reasons why a firm might prefer this to NPV, and then talk about situations where this may not give you the correct answer, or let's just say not the same answer as NPV. And since we know that NPV is the gold standard and always gives the right answer, if this gives a different answer, that's a problem. So let's talk first about the metric. Again, we start out with the future cash flows, initial investment, all the cash flows in the future. We don't start out in terms of calculating the metric with a discount rate. In fact, that's what we solve for. So in the past, remember with the net present value, I gave you a discount rate and you needed to solve for present value. In this, we know that what we're targeting is a present value of 0. And so the question becomes, what discount rate will give us a present value of 0? So look at that. Let's just take a quick look at an example here. Remember our example from before. We start out with a $1,000 investment, and we initially put in a discount rate of 10%. Here are our cash flows. And we came back and said, oh, that has a net present value of $444.34. Well, I'm going to click on this and put a little color on it now. Now, let's just say that we want to drive that net present value to 0. Remember that driving net present value to 0 at a point where the net present value is 0, the project just breaks even. It just barely pays off its cost of funding at whatever the discount rate is. And so you can almost think of this sort of like a break-even analysis, but we're going to use a little tool in Excel called the Whatif Goal-Seek analysis. So we go to Data, Whatif Goal-Seek. Again, I'm using a Mac. On a Windows computer, this may not look exactly the same, but it will still be under the Data tab. It will still be under Whatif Analysis. It will still be called Goal-Seek. And what we're going to do is we're going to set the NPV value, so I just clicked on that, equal to 0 by changing the discount rate. Hit OK. All right, it solves through and says, how about 23.29, call it 292%. Okay, and at that point, basically the net present value is equal to 0. And so as a calculation, the reason that this is, we talk about the fact that this would be really hard to do by hand, is that quite literally what this Whatif analysis is doing is trying a whole bunch of different values of the discount rate, calculating out the net present value for each of them, and sort of honing in on the one that gets you to 0. And so, it'll start with whatever discount rate you have, and it'll move it up by an amount and down by an amount, and see which one of those moves the value closer to 0 as opposed to further away from 0. The one that moves it closer, it'll move more that direction, and it'll keep doing that until it maybe potentially overshoots 0 and goes, starts seeing a value in the other direction, and then it'll back up from that a little bit. So it's an efficient algorithm in a computer for doing it, but you could imagine if in that process you maybe had to recalculate net present values by hand 40 or 50 times for the same project to sort of hone in on this correct rate, that would drive you crazy. So again, the advent of the computer, the advent of the spreadsheet, and of this kind of what-if analysis is really what's led to the rise of this. So in our example, as we said, we basically solved for a net present value of 0 by moving the discount rate, and we come out with a discount rate of 23.29%. Simple way to interpret that would be to say that for the amount of money that you have invested, if the return on that project, if the return were 23.29% on the project, the required rate of return, you'd have a net present value of 0. Some people interpret it the other way to say that you basically earn 23.29% for every dollar invested on an annualized basis. I'll show you in a minute why maybe that's not exactly the right way to think about this, but it certainly is correct to say that if, as an investor, you required a 23.29% return, this would be a break-even project for you. So, in terms of the rule, then what you're supposed to do is define what your actual capital costs are. In our prior example, our capital costs were 10%. And so then you just compare this break-even cost of capital to what your actual cost of capital is. If your internal rate of return, so your break-even cost of capital, is greater than your cost of capital, that means the project is returning more than what the cost of capital is, then you like it, and so it's acceptable. If the IRR is equal to your cost of capital, and so let's say that your cost of capital was 10%, we did the Whatif analysis and we came out with 10%, then that again would mean your project's just barely break even. It's just enough to pay off the cost of capital. Probably then does not really add any value to the company, and you probably would call it unacceptable. Just not worth doing if all it's going to do is leave you in the same position you would be in without doing it. And if IRR is less than 0, then what that means is that it returns less than even your cost of capital. And so by doing the project, you're destroying value, and so you would not do it. So why do people like the IRR rule? Why is it so popular? I think, honestly, the most likely explanation is that there is some intuition. People like this idea of thinking in terms of, we're gonna look at projects, we're gonna look at investments in terms of their rate of return as opposed to how many dollars we're gonna get back. We just feel a little bit more comfortable with that. And so it becomes kind of like this annualized rate of return that you compare things on. As I'll show you in a minute, that's not really what you're getting with the IRR, but that's the way people like to think about it. The second thing that often people say is, well, I like the fact that I don't have to solve for a cost of capital to do the calculations. It's true. However, you can't apply the rule without knowing the cost of capital. In other words, it's true you don't need to know what your cost of capital, sort of your threshold cost of capital is in order to calculate IRR, but to use it to make a decision, you would have to compare whatever your IRR is to whatever this threshold is, so you got to have it anyway. And some people just like it because many times in different investment decisions, we're looking for a break-even analysis. At what point would we be indifferent between sort of the choices? And a lot of times that makes it easier to make the decision without really honing in on something. And so let's just use this as an example. I know in theory you're supposed to know exactly what your cost of capital is for this. But if you solved for, let's just say, a project with an IRR of 23%, and you kind of knew, I don't know exactly what my cost of capital is, it's somewhere maybe 9 to 12%, it's somewhere in that range. Might be different depending on different things changing in the economy, but I know it's definitely not 23%. Then I don't really need to go figure it out exactly to solve this. And so since we know that the break even at this point is a return or reflects a cost of capital that's so much higher than what we care about, then we wouldn't do it. Same thing could be true the opposite direction. If we solve on a project and we got a internal rate of return of 2%, we wouldn't really need to know what our actual cost of capital is in most cases to be able to say, well, it's just not worth doing at 2%. And of course, if it came up with a negative percent, we definitely wouldn't be doing it because most of us don't have a negative cost of capital. So those kinds of things I think are why people like it. Well, despite the fact that they like it, it does have some issues with it. One of the big ones that I kind of want to point out to you is that it assumes that all of the project cash flows are reinvested at the internal rate of return. And so remember the example that we did before where we said think about the alternatives for the investor. Alternative A is that they just get the initial amount and invest it, and alternative B is they get the cash flows each year and they invest those. Well, so IRR, the way that its calculation is built and works, assumes that whatever cash flows we give back to the investors, they can reinvest those at the project rate. Well, why? I mean, just because this project can generate a certain level of return does not mean that outside of this project that an investor can get that. And in fact, for a given level of risk, we pretty much know what kinds of returns investors can get in the market. So why wouldn't we use what we know their returns can be as opposed to just imposing this on it? And we'll talk a little bit more, and I'll run an example on that. The second thing is that in many what we would call common project investment scenarios, the IRR calculation can return more than one result, and the differences in terms of the rates can be quite different. And there are actually scenarios where the internal rate of return solution won't come back with a result at all. It can't find a specific rate of return that gets you what you want, gets you to an NPV of 0. And so that becomes frustrating because if you're a company that really wants to use this rule, what do you do when it comes back with two different numbers? Maybe one return is negative and the other one's positive, or it doesn't come back with any number at all. Obviously, that's frustrating. And then last thing, and I'll give you an example of that, is that the approach could actually cause you to select something that is clearly wrong. So obviously wrong that you wouldn't even need to do the calculation to know it. So let's talk about those examples. As I said, it assumes that all cash flows from the project are reinvested at whatever the internal rate of return is. And we know that depending on the level of that return, this is probably not true because we kind of know what the market rates are. So to show you that, I'm going to give you just this quick example. So consider, just like we did before, these are the same projects, all right? So we're going to do the projects. It's $1,000 invested, right? And of course, we can do them like I've done here as amount of cash flows that you're going to get in each year, 0 through 5, and what the future value of those are. And so we've solved for their future value, all right? And so then we find ourselves in this situation where what we want to do is to basically figure out between the alternatives. If you think about what we're saying when we say a net present value of 0, what we're basically saying is a project value that would give them the same amount of money as if we just gave them the money and let them invest it. So if we're looking for a discount rate that will set the future value of cash flows that the company gets from doing the project equal to the amount of cash flows the shareholder would get if we did the project, paid them dividends, and let them reinvest those dividends. It would give them the exact same future value as if we just gave them the $1,000 up front and let them invest it. All right. So to get to that, we're going to use this what-if analysis, but what we did is we created this difference field. So it's just the difference between these two future value numbers, and what we want is for that difference to go to 0. So we're going to go into our little what-if goal seek. Again, we're going to set this difference equal to 0, and we're going to do it by changing the discount rate. And I've made sure that there's a formula in there that ties so that this discount rate sell and that one are the same, so they'll both change at the same time. You see them both change, comes up to 23.29%. Interestingly, it's the same value we got if we just solved over here before. That's good news. And you'll see that what it does is basically say, oh, it's the rate that makes the future value of each choice equal to $2,848.88. Okay? Here's the gotcha on that. Okay? When we change this discount rate, we're changing our compounding. And so what we're saying, just so that you can understand that, is, for example, if you give me a $500 cash flow in year 4 and I invest it for a year, that I'm going to get 123.29% growth in that. So it's going to go from 500 to 616 in 1 year. Now, we're not talking about that you can do that inside of the project. We're talking about that an investor could take their money and go out into the regular market and find something to invest in that would earn them 23.29%. Clearly, if they could do that, then the cost of capital on the project would be 23.29%. And this wouldn't just be a theoretical break even, this would be actual break even. So we don't love that. And in here, similarly, we are basically assuming that they could take the $1,000 today and invest it in something that would return 23.29% per year for 5 years, and that those would be comparable. So again, I don't really love the that built-in assumption. That seems like a real problem to me. Again, in many, the second issue that I noted, in many common project investment scenarios, this thing is unreliable. So what we can say is that the only time that the project will reliably result in an unambiguous one value is when the sign of the cash flow switches between positive and negative only once over time. So we call that monotonic, meaning the cash flows either start out negative and go positive, and as they go, they continue on that way, or they are positive and they go negative. They start out positive and they go negative. Either of those are fine, but if they start switching back and forth between positive and negative, so say they start out negative, go positive for a while, and then maybe you have a reinvestment you have to make and they go negative, and then they go positive again. The IRR might solve for a single value, or it might solve for multiple values, or it might not solve for any value. All right? And bottom line is that unreliability causes a problem, and quite frankly, it would be hard to know in some cases which is the correct IRR. The algorithm that Excel and others use for solving for kind of this what if type calculation say just put in a guess, and we'll if there's multiple choices, we'll give you the one that's closest to that guess, which I guess that's better than nothing, but quite frankly, what if your guess is wrong, or what if you're trying to get your project accepted and that if you alter your cash flow pattern just a little bit, you can take advantage of this guessing to produce an internal rate of return number that is acceptable, even though it's not really the right number for people to be using. So we don't like it simply because it's not definitive. And I'm not giving you an example of that. That's fairly complex, not only to do but to follow, and so I just want you to kind of be aware that it's got this issue. And the last thing is that it could lead to accepting projects that clearly destroy value. This one, again, takes a little bit to wrap your head around, but this time I'm going to go ahead and give you an example. So consider 2 projects for a firm. They have what I would call mirror image cash flows. And by that, what I mean, imagine a project A, I'm going to invest a certain amount of money up front, so it's a negative cash flow up front, and receive positive cash flows thereafter. That'd be a lot like the project we just had. Then consider a project B right, that involves us getting money up front, same amount we would have invested before, right, and paying the cash flows thereafter. And so it's positive up front, negative thereafter. And you might think, well, those kinds of projects never happen, but they actually do. An example for some companies might be, I'm going to sell a building and then lease it back. All right, and so up front, I'm going to receive all the cash flows up front from selling the building, and then when I lease it back for use, I'm going to have these negative outflows from leasing it back. And maybe it's a good decision because I'm only going to need it, the building, I'm only going to need to lease it back for a few years. Who knows? But those kinds of projects do come up. Believe it or not, the internal rate of return rule would basically say these two projects are the same. All right? And to show you that, let me just give you a quick example here. So here we have two projects. Again, they're mirror images of each other. And you can see that by basically saying that at the proper discount rate, one of these has a positive NPV, the other has a negative NPV. Latch onto that, right? Okay, so this one pays $1,000. You invest $1,000 up front, and you receive these cash flows over time. The other one, you have a negative investment, meaning you're receiving $1,000 up front, and then you're paying out these negative cash flows over time. Okay. Thing I want you to really focus on that is, the net present value, just the plain old value, the fact that if you were to sum all of these up, they would basically add up to, $2,000 worth of payments out for $1,000 in. Everything about it tells you this project is probably not a good project. And yet, if we were to go in individually on these projects and just put in, since we've already got it, let's just put in the 23.292 rate that sets this to 0, and the 23.292 rate that sets that to 0. Guess what? What our calculator tells us is that this project, both of these two choices, have the exact same IRR. All right, and so in a nutshell, what that means is if you were only looking at internal rate of return as your decision metric, you would put these two projects on par and say they're equally good projects. If we can do them both, let's do them both. And oddly enough, what you know is that they're mirror images of each other, and therefore one of them is going to wipe out the value from the other one, and you're going to wind up with nothing, right? And so an IRR rule would tell you do them both, even though doing them both basically involves doing nothing. And doing nothing by definition doesn't add value to the project, which means that if one of these is adding value, the other one must be destroying the same amount of value. And we saw that when we went back and did them at their cost of capital and saw this one's adding $444, this one's destroying $444, and they're sort of netting out. We don't really love that. So again, kind of like with a payback period, you can talk about all of these issues, but nonetheless, people are starting to use internal rate of return, and more companies are including it among the things that they calculate in capital budgeting. So you have to sort of defer to those users a little bit and try and get into their mindset and understand why they might be doing this. I think the number one thing that probably is relevant in terms of people using internal rate of return is that the evidence suggests that nobody is using only internal rate of return. And so, for example, this last situation where the internal rate of return would have said do a project or consider a project viable, even though it has a negative NPV, most people would not look at only the IRR. They would look first at the NPV, and based on that say, only look at the positive NPV projects, and then use IRR to try and get a sense for how much above the cost of capital the project's returning. Also, they may use payback with it, they may use other things, but as we talked about before, they will never just do this in a vacuum. Just like with payback period, just like it with NPV, you'll be asking a lot of other questions and trying to understand a lot of other things before deciding on the project, and this just becomes one metric among many that you look at. The thing though that I can't emphasize enough is that generally speaking, you should be looking at NPV first and then looking at other metrics if you want to get a little bit more information. That does create some confusion. I have worked with companies where, just because somebody feels like they like it or understand it better, or it's the cool way to talk about projects, they really want to go on an IRR basis first and then NPV after that. And my experience generally is that you do have to pull them aside and basically say, NPV is the gold standard, always gives the right answer. You should always start with that and then use the others for additional insight. Usually if you talk that way, you kind of turn them around. Anyway, remember that the whole goal of this section, we've already talked about net present value, and the whole goal of this section is really to just, I don't want you to get out of here thinking that companies either only use net present value or should only use net present value. Last thing I want is for you to show up at a company and they're like, oh, when we do capital budgeting, we do net present value, payback period, internal rate of return, and you being fresh out as an undergraduate say, well, that's stupid, you should only do net present value. I want you to know what the others are. I want you to know why people use them. I want you to know how those compare to net present value. And so hopefully this gives you a little bit of insight into that. Thank you.